Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of understanding systemic risk, what it means for the global economy. In today's interlinked financial markets, systemic risk is a term you can't ignore. Think of it as the domino effect we often see in the economy. It starts with a small crisis but has the power to trigger a global meltdown. When one part of our financial system falters, can it bring down the whole system with it? Yes, and that's what systemic risk is all about. Understanding this risk isn't just for economists, it matters to anyone with a stake in the market. Imagine waking up to find your investments have vanished overnight. This is why recognizing the signs and impacts of systemic risk is crucial. We dive into how it can shake the very foundation of global markets and what it means for the future of the economy. Defining systemic risk. Systemic risk isn't a term to take lightly. It's the monster lurking beneath the surface of our financial systems, ready to wreak havoc. Unlike risks that are confined to a single entity or sector, systemic risk can spread like wildfire, affecting entire economies. But what exactly gives this risk its notorious sting? Characteristics of systemic risk. The defining feature of systemic risk is its ability to transcend boundaries and turn a localized issue into a widespread crisis. A few characteristics set it apart. Interconnectedness. Much like a spider's web, financial systems are deeply interwoven. When one strand breaks, it can destabilize the whole structure. Think of how a major bank failure could ripple across markets, affecting hundreds of other institutions. Contagion. This spreads faster than the flu in an unvaccinated population. Once it starts, the speed and scope of its impact can be overwhelming. Businesses across sectors may find themselves in a struggle for survival as the effects propagate. These traits make systemic risk uniquely challenging, extending beyond typical market ups and downs to threaten the very stability of financial systems. Types of systemic risk. Diving deeper, systemic risk doesn't just come in one flavor. It wears many hats, impacting different areas in various ways. Financial risk. This is perhaps the most familiar. It involves the collapse of financial institutions or markets. Remember the 2008 financial crisis? That was systemic risk in full swing, showing how interconnected financial institutions can drag each other down. Operational risk. This often slips under the radar but can be just as damaging. It's about the failure of internal processes or systems. Think of a massive cyber attack on banking infrastructure. Such an event could halt operations, leading to widespread chaos. Liquidity risk. In times of crisis, liquidity can dry up faster than water in a desert. This happens when entities can't convert assets into cash quickly enough to meet short-term obligations, causing a squeeze that can spread panic across markets. Understanding these types helps us recognize systemic risk's multifaceted nature and the myriad ways it can manifest, posing serious threats to economic stability. Each type has its unique triggers and impacts, calling for vigilant monitoring and strategic mitigation. Historical examples of systemic risk. Systemic risk isn't just an abstract concept for economists to ponder, it's played out in the real world with serious consequences. We can look back at history to see how systemic risk has unfolded, with two notable examples: the 2008 financial crisis and the burst of the dot-com bubble. Both events left significant marks on the global economy, serving as poignant reminders of the potential domino effect within financial systems. The 2008 financial crisis. The 2008 financial crisis is a textbook example of systemic risk tearing through the financial and mortgage industries. It all began with the housing market in the United States, where banks and lenders were handing out subprime mortgages with little regard for borrowers' ability to repay. It was a case of short-term gain overshadowing long-term sustainability. Banks bundled these risky loans into mortgage-backed securities, selling them off to investors worldwide. The profits were attractive, but it was akin to building a house on quicksand. When homeowners started defaulting on their loans, the value of these securities plummeted, leading to massive losses. Large financial institutions, thought too big to fail, crumbled under the weight of these toxic assets. Lehman Brothers' collapse became the crisis' infamous flare point. The ripple effects were swift and brutal, freezing credit markets and crippling economies globally. Governments had to step in with bailouts to prevent a complete financial meltdown. This crisis underscored how deeply interconnected and fragile our financial systems can be, making systemic risk a real threat. The dot-com bubble burst. Another tale of systemic risk played out in the late 1990s with the dot-com bubble. During this period, internet-based companies were popping up like mushrooms after rain, attracting investors eager to cash in on the next big digital innovation. Money flowed into tech stocks, inflating valuations far beyond realistic expectations. But this couldn't last. By 2000, the bubble burst. Companies that promised the moon but delivered very little found their stock prices plummeting. Investors panicked, and the sell-off ensued, draining billions from the market almost overnight. This didn't just affect tech companies. The financial turbulence spread across sectors, impacting overall investor confidence. Economic growth slowed, and some argue that it contributed to the early 2000s recession in the United States. The dot-com bubble's burst is a clear illustration of how exuberant market behavior, driven by speculation, can lead to broader economic challenges, highlighting systemic risks reach beyond individual sectors. These instances show us that systemic risk is a powerful force, capable of sweeping across markets and economies with little warning. Understanding these historical events helps us prepare for the future, offering lessons on the importance of vigilance and strategic foresight in managing financial systems. Causes of systemic risk. The financial system is intricate and often unpredictable, much like a house of cards where a single disturbance might trigger widespread instability. Systemic risk emerges from various sources, each contributing in different ways. To get a handle on what fuels this risk, let's explore these key contributors. Regulatory failures. Regulatory systems are designed to maintain market stability, yet their shortcomings can significantly exacerbate systemic risk. Regulatory gaps often mean that new financial products, especially complex derivatives, can slip through the cracks, leaving them loosely supervised or completely unregulated. This is much like driving without seatbelts, comforting in the short term, but potentially disastrous. Failures in regulation can also stem from a lack of foresight in adapting to financial innovations. Often, regulators are a step behind, struggling to catch up with the rapid evolution of markets. This creates a breeding ground for risks that might go unchecked until they've grown too large, a ticking time bomb in the financial landscape. It's crucial for financial oversight bodies to anticipate changes and implement protective measures before problems manifest. Market dynamics and behavior. Financial markets are as much about psychology as they are about numbers. Investor behavior plays a pivotal role in shaping systemic risk, often driven by emotion rather than logic. Herd mentality can lead to bubbles fueled by overconfidence or panic-driven sell-offs, reminiscent of a school of fish, where one goes, others blindly follow. Consider the frenzied trading during periods of steep market upswings or downturns. Fear of missing out often drags more investors into the mix, inflating asset prices unsustainably. When reality sets in and the bubble bursts, the fallout is swift and severe, amplifying systemic risk. This highlights why understanding market sentiment is as important as quantitative analysis, a balance of logic and emotion. Globalization and interconnected markets. In today's world, financial markets are more interconnected than ever before, weaving a complex web that spans the globe. This interconnectedness amplifies systemic risk, as shocks in one country can ripple outwards, much like how a single stone disturbs the surface of a calm pond. While globalization brings opportunities, it also means that financial disturbances in one region can lead to cascading failures across borders. A sudden change in currency values or unexpected regulatory shifts in a major economy can trigger domino effects worldwide. This global interdependence underscores the importance of international cooperation in managing financial risks, a shared responsibility with far-reaching implications. By understanding these causes of systemic risk, it becomes clear that vigilance and proactive management are essential. Preventing systemic risk isn't just the job of regulators or financial institutions, it's a collective duty that involves staying informed and prepared for potential disruptions. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.